All right, welcome back. This is the Something Ventured podcast. I am Kent Lindstrom. I am your host. My guest today is Nnamdi Okike. How are you doing?
Oh, doing well. Hey, thanks so much for the invite.
Oh,
Excited to be part of this, and
Uh, this
thanks
is
for
gonna,
having me.
this is gonna be great. So Nnamdi founded it's done a bunch of things, but founded a venture capital firm called 645 Ventures, which he co-founded with his partner Aaron Holliday. Their most recent fund, about $350 million. Good for you. That's pretty
Thanks.
impressive.
Yeah, thanks
Um,
so much.
Before that, he was at Inside Partners. We'll talk about that. That's huge.
Yeah.
Um, he's a member of the prestigious NVCA, that's the National Venture Capital Association board. Charles Hudson just became the chairman of this,
That's right.
a former guest on
Yeah,
this podcast. That's a, I don't know, that's something you
yeah.
thought you might never see. That's
It's
pretty cool.
exciting to have Charles as chairman. He's just an awesome guy, wonderful investor, but also just a great person. Um, and we're excited to have him as chairman. I think he'll
Yeah,
do a great job. So yeah,
it's pretty cool. What,
yeah.
I'm going through your background. You start out, Harvard, and then Harvard again, and then Harvard a third time. Like, you went to the business school, you went to the law school.
Yeah.
What you seem like early on you're achieving something here. What's going on in your young life as you kind of get started here? That you seem to be pretty close to the top of the game right away. What's driving you there?
Um, yeah, it's an interesting question. I guess I'd say a couple things. Come from family of immigrants. My dad's from Nigeria. My mom's from Germany. They met in Germany where my dad got a scholarship to study medicine. Both kind of came from pretty humble means. My dad grew up in a village in Nigeria. My mom actually grew up on a farm in Germany. So both kind of, modest means, both kind of, came to the US together kind of with the dream of, kind of maybe better life for themselves and their family, but also really prioritize education. So that was kind of something very big for me,
Interesting.
kind of growing up. I'm a middle child, so I have an older brother, younger sister. And so, kind of academics was a big part of our family. And, kind of that was always the avenue for achievement. So that was kind of instilled pretty young. But let's see. So to your question around kind of early accomplishments or kind of what I did before getting into venture. So, went to Harvard College. I really wasn't sure what I wanted to specialize in or what I wanted to do for a long-term career.
You didn't major in
You,
venture capital.
no, I didn't major in venture capital. So when I first went to college, I thought I was, going into medicine because my parents were in medicine. My older brother, went into medicine. Um, so I started off actually as a biology major, kind of pre-med, and then I kind of realized that wasn't something I was super excited about. I couldn't see myself long term, kind of in the medical field. So I had to kind of figure out like what was interesting. And so, when I was in college, this was the early days of the internet. Kind of, I graduated college 2002, so a long time ago. Um, but at the time, it was the early days of the web. So there were a lot of companies getting started, and folks were building companies at MIT and some were at Harvard. And so I was kind of intrigued by that, and I had some friends starting companies. I had one friend. I ran track and field in college, and he was starting a soccer internet site
Yeah.
called Hoopsito, and he was raising actually venture capital at the time. And I was like, "What's venture capital? Kind of like tell me about what you're doing. It seems pretty cool. You're working on something interesting." And so that was kind of my first window into the tech world. And then I took a class. So really, what really kind of introduced me to venture was I took this class at MIT at their Sloan Business School called New Enterprises. And as an undergrad at Harvard, you could cross-register over at the Sloan School. So I went over there, I took this class, and it was really an eye-opening class. It was taught by a couple of folks who were venture investors. Todd Dagris, who co-founded Battery Ventures, went on to co-found Spark. Another guy named Howard Anderson, who also co-founded Battery in a firm called Yankee Tech Ventures. And those guys were teaching this class. And I said, hey, these guys are doing some pretty interesting things. And like these guys are the guys, kind of backing startups, and they're investing in these amazing companies. I didn't even know this was a job. It's pretty interesting. This is kind of how these companies get funded. And so that's kind of how I first got exposed to VC in the tech world, was through that class and a couple of classmates. And yeah, I just found it really interesting.
That's That's funny. Yeah, I went to Kellogg, Northwestern's business
Yeah.
school, and there's like a an entrepreneurship class, and all these MBA students would show up, and it was kind of funny because they'd have these successful entrepreneurs come in, like these guys who'd
Mhm.
made a ton of money.
Yeah.
In Chicago, it's not always tech, but they made a ton of money, and they're like, "What can you teach us?" And they were all like, I don't know. I wouldn't go to business school. It seems like a waste of time, like a waste of time. And I just kind of started working, and
Funny.
I guess I'd study accounting again if I could, like.
Yeah.
And
Yeah.
everyone's like, "No, I just want to get to the part where I'm rich, like you." What
Yeah.
you
That's
ran
funny.
track and field at Harvard? You said what event did you run?
So I was a middle distance runner. So I ran 400
400.
meters, 800 meters.
Mm,
So one lap around the track or two laps around the track.
yeah,
And
those are great
yeah, it was a
races.
really fun experience. So a lot of my good friends today are kind of folks I ran track and field with. Sports was always a big part of my life as well, kind of growing up. So played basketball, ran cross country, and then track
Yeah,
and field, and then ran track and field in college. Always kind of had that competitive, aspect. And, a lot of my, I would say the early experiences, like formative experiences, were kind of athletic experiences, kind of love playing on teams. Even today, I still run a lot, kind of more now like 5Ks, that kind of thing. But,
yeah, that's cool.
love to train and compete and that kind of thing. So always was a big part of my life too.
I ran the 400 in high school in San Diego, and
Oh, is
then
that right?
and then I went to Northwestern, which is a Big Ten school, and I did not participate in track and field at a Big Ten school. Let me let me tell you that. So you're animated by both. It's interesting. You catch the kind of internet bug, which I think a
Yeah.
lot we all did. We see this. This is amazing. Like this is a thing that's going to transform the world. And you could kind of say, do a lot of people go start their own thing? Hey, I'm going to
Yeah.
help people discover music, but you
Uh-huh.
also catch the venture. So how do you end up getting on the venture capital side of this right away instead of,
Yeah,
you
yeah.
know,
So great question. And that was also maybe where luck kind of came in.
it's always the way.
So yeah, I guess it always is. So I first got into VC. It was actually an interesting story. So, the summer before my senior year in college, I said, hey, I got to get some business experience. And so I went to work as a consultant. I got a summer internship at Boston Consulting Group. It was my first real kind of like business job. So I went there and, I thought I was doing a good job that summer. Gets to the end of the summer and I sit down with my, I guess called Kate. I forget exactly what his title was, but the person kind of like overseeing the internship.
Yeah.
And he was like, yeah, I'm sorry, like you're not getting an offer to return, like I'm not sure this is for you. And I think he was right. Like I didn't love consulting.
Yeah.
And it kind of made me say, okay, like, what's an area of business that I'm really excited about? And as I mentioned, I'd taken this class at MIT on, the business or the kind of finance of entrepreneurship and technology. And so I knew a little bit about venture. Um, and this firm, Insight Partners, was recruiting for analysts at the time. So they just started the firm in '95. I think it was part of their second analyst class. So they were just starting the analyst program there. And so I interviewed there, and because I knew a little bit about venture through this, kind of MIT Sloan class, I got this job as an analyst. And so my first job out of school was working for Insight doing deal sourcing.
Yeah.
And so I come to New York. I was all excited about it. Go to the office, and my first job basically was I was basically a cold caller. Like I was a telesales guy, and I'd basically pick up this phone. This is back in the days where folks had, kind of phones on their desk. I kind of, it's funny, like describing these things, it seems pretty ancient, but you had this, you were given a phone, you had a laptop, and your job was basically to call up founders
Wow.
and kind of learn about their companies and try to figure out could they be a fit for the fund. So my first job literally was sitting at this desk and basically calling up entrepreneurs and learning about their companies and pitching them on Insight. And I just really loved the work because every day I could come in and talk to these amazing people, building companies and learn about what they did and, kind of like hear their whole founder story. And I just found it fascinating, so.
And what was Insight at the time? It's funny that's calling the entrepreneurs. Some of the you never know what's true, but some of the venture capitalists who are the early guys in Silicon Valley talk about driving up and down
Yeah.
The streets, it's pulling into a parking lot, and hey,
Yeah.
what does Techodyne do, or whatever this is. And so Insight eventually becomes today. It's a monster, right? It's like
Yeah.
18
It's
billion or 20
massive firm. Yeah.
under management. Well, at the time, was it heading that way, or was it there? Or
Insight at the time was really small. So I first joined them. I think they were on Fund 3 at the time. They were probably like maybe 15 people.
yeah,
They started, as I mentioned, in 95 with a small fund. And they had grown somewhat. So I think they were managing maybe like 300 million in AUM across their funds,
yeah,
but still very much a boutique, focused on bootstrap software companies, investing primarily at kind of Series A, Series B
yeah,
stage. Um, but kind of pioneering this outbound sourcing approach that they'd kind of taken from Summit and TA, but really kind of focused it in on these kind of like bootstrap software companies. And
mhm,
you could always see they had like big aspirations,
yeah,
so we were looking at companies across the US, it evolved into looking at companies across the world. Um, and they really kind of created this system and almost like a machine to find companies, kind of leveraging this junior team. So at the time, again, it was a small firm, but I think you could see they had aspirations.
yeah,
They had some good success in the first fund, and also they had great timing. So they
yeah,
started the firm in '95. So between '95 and 2000, it was kind of this gold rush time.
yeah.
So they had a lot of early wins, exits, and IPOs and things like that, and that kind of gave them a great start. So
Yeah.
that was what the firm looked like in the early days.
So are your parents cool with this? The parents who want you to go to once in a while, isn't like Sergey or Larry's mom really disappointed that he never finished his PhD kind of thing?
Yeah, it's funny. I never heard that story, but I guess there's a lot of stories like that. So I remember when I told my dad, look, I'm not going to be a doctor. I want to do something else. I want to go into business. Um, my dad got all worried. So he called up the one person he knew. We had a family friend who was like a biotech. He had a medical degree, but he was a biotech, operator. He became a biotech entrepreneur. And my dad called him up. He's also Nigerian. So he's a good friend of my dad from growing up. And my dad said, hey, like, my son wants to go into business, but he doesn't know anything. He doesn't like know a trade. He doesn't have any specialization. He says he wants to go into business. Like, what is
It's
that?
like venture capital, perfect.
Yeah, yeah. And in this family friend was like, look, it works differently here in the US. Like you kind of get some background, you kind of get into maybe finance or consulting or something, and then you kind of learn and then you eventually specialize later. But like you don't, it's not like you have a vocation or a trade or a specialization early on. And so my dad's like, well, he's going to go work for this firm called Insight. And this family friend was like, okay, it looks like a credible firm. They've raised a couple, funds. He's doing okay. So I think that gave my dad
Yeah,
some,
yeah,
like he's like, look, he's on a good path. But it was actually really interesting. I think my dad now is really, he finds, tech really intriguing. I think he likes the aspect of kind of innovation and, the idea that you can start a company and build something. But yeah, I kind of had to create my own path.
yeah,
But I think a lot of folks are like that, right? I always view my personal belief is that like when you're thinking about building a career, you want to find something you're super passionate about. You maybe want to go off the beaten path,
yeah,
and really spend the time to try to figure out like what gets you excited. And for me, when I went into venture, I said, look, I'm never going to be bored by this job. Like every day I go into the office and I have a chance to look at a new idea, work with, founders who I really believe are kind of changing the world, and it's inspirational and it's exciting. So once I kind of found that, I said, hey, this is a great thing and I want to be part of it. And that kind of was what launched, my career, I guess.
oh, that's great. And at
Yeah.
some point, yeah, it's funny. I had Maha Ibrahim on the podcast, and she's been a venture capitalist for a long time, and
Yeah.
says every once in a while she thinks about doing something else, like retiring or moving on to something else. And
Uh-huh.
she's like, but that week somebody just walks into my office and tells me something incredible, and I'm just
Yeah.
hooked again. So it's at some point you decide to take this perfectly good job and leave it and
Yeah.
start your own thing. How does that?
Uh-huh.
Are you thinking, hey, I could do something different, or I like what these guys are doing. I want to replicate it. How do you decide? I mean, that's starting your own venture fund is a thing.
Yeah. That was interesting. So when I first went into venture, um, I always had a little bit of like an entrepreneurial ambition.
Mm,
So when I first went into venture, I said, hey, like maybe I'll do venture for a couple of years and maybe join a startup or found a startup. But I like venture so much, I kind of said like, hey, this is the place I want to kind of stay in. I really want to learn the business. Um, and so after spending about 8 years, almost 9 years at Insight, it was really the fact that I saw an opportunity more than anything. So, going back now, back to 2014 when we launched the firm, I was seeing a couple things that my partner and I describe as like structural changes happening in the market. And I felt that a new firm could really capitalize on those. So the changes were really the following. I think the first was the cost of starting a company had gone down through things like AWS, kind of the App Store, kind of downloadable software. And I was seeing this at Insight. Like a lot of our best software companies were downloadable software companies that kind of grew organically and had, really good, economics when we first kind of invested in the companies. And so I was seeing some of these changes, kind of firsthand there. Um, there was also this idea that like, hey, these companies require less money. There are more of them. They're getting started in a pretty broad range of geographies. Um, and I felt that traditional venture wasn't really effectively servicing those companies. Not to mention, I believe that a lot of the traditional early stage venture model was really geared toward a previous time when, as you mentioned, like maybe the majority of companies could be found on Sand Hill Road or Route 128 in Boston,
Right.
and where firms were just looking in a kind of 45-minute or kind of like small radius in terms of kind of companies being close to them. Um, I was seeing the Insight model that was being applied across the world and finding amazing companies in these smaller cities and kind of far-flung places, and I kind of believed that that was going to grow, and I felt that you could apply a model at the early stage to go find those companies, but you had to basically introduce a outbound sourcing element at the early stage, which had really never been done, and you had to find a way to systematically kind of comb through the many companies to find the exceptional ones, and that's kind of where software analytics outbound sourcing could really come into play. And so part of what I was seeing was this idea that like, hey, you could kind of build almost like an Insight for the early stage, leveraging outbound sourcing, software, data, a value add team. Um, and I felt like, hey, that could be an interesting, basis for a new firm. And my co-founder, Aaron, was thinking along the same lines. Aaron had been at a fund called DFJ Gotham Ventures in New York. He's a computer scientist. He was kind of saying like, hey, venture funds aren't really using technology in their operations. Why is that? Couldn't you actually like start to embed data and software as part of a venture firm operation? And so we kind of had this meeting in the minds in early 2014. And we just said, hey, like, let's take the plunge and build something and, kind of see what we can kind of create. So that was kind of the early inception story.
And how do you and your partner come together? Building a venture fund is a long term. A startup, you can't hope you hope it's a long term thing, but might only be a couple year thing. But building a venture capital firm is a pretty long term partnership. The dynamic of the partners are pretty important.
Yeah.
How did you guys come together and align? And there's a lot of ways to do a venture fund, right? You can have a fund. Hey, we have a fund. We make a lot of money. We're done. Or you
Yeah.
can build an institution, which pretty seems to be what you're doing.
Yeah.
How do you guys align on that early and not risk like 8 months in, like, oh, we just, boy, we don't like each other. And oh, like,
Yeah. That was a little bit of a leap of faith, right? And I think ignorance is bliss a little bit. Like kind of looking back, you realize that, hey, like it was a risk, but at the time you're just so excited, you don't really think so much about that. So, just to kind of backtrack. So Aaron and I first met, we were first introduced by a founder, a lady named Karen Moon, who started a company called Trendalytics. She was a friend of mine. I was actually an angel investor in her company. Aaron was kind of mentoring her when he was at DFJ Gotham Ventures. So she introduced the two of us. And at the time, we both kind of had independently started to formulate a new fund. And so we kind of sat down and we kind of shared our notes. We said, hey, like we're kind of thinking along the same lines. And we had a set of meetings over the course of maybe like, I don't know, probably like 6 months where we were just kind of sharing ideas, sharing deal flow. I'd done a few early deals in this thing called a warehouse portfolio. So basically made some angel investments that were being put into the fund. And so Aaron and I kind of were sitting down and just sharing our notes and learning from each other. And we said, hey, like we're kind of thinking along the same lines. We have a similar idea. This is, we're better together, in terms of
Mhm.
1 plus 1, potentially equaling 3. And so we said, hey, like let's try to build this, firm together. And we started to fundraise together, that first fund. And I think that experience in itself was kind of a little bit of a proving ground because it was
Yeah.
hard to raise fund one. We had
Yeah.
to be super scrappy and, really make a lot of sacrifices to kind of make that work.
Yeah.
Um, and so over that period, I think we really got to know each other, like how we ticked and, and we said, hey, like this could really work. And we structured it in a way where if it didn't work, we could kind of separate. There was vesting. We kind of put, certain things in place where we could each go our separate ways if it didn't work out. But I think we had this belief that, hey, like we're both in it for the long term. I think one thing that really brought us together was this idea that like, if this works, like it's going to be the only thing we do. Like we're not trying to do multiple things or kind of dabble in investing. Like we both said, hey, like we really want to build a firm for the long term. We're super committed. We're willing to make these sacrifices early on. So I think we had the same kind of mission.
Yeah.
I think that helped a lot.
Well,
But yeah,
super successful now, but 2014, you guys come together.
yeah,
A couple African American guys starting
yeah,
a venture firm, going out to raise money, ask people for money.
yeah.
I guess I'll now ask you the dumbest question you've been asked probably in a month, but did you experience any bias along the way, or how did that impact the already hard fundraising process?
Yeah, it's a good question. Um, Looking back on that, I believe we did, but it wasn't overt, right? So it wasn't
Yeah.
nobody ever said, hey, like, you guys are two African American guys, kind of building a firm. We haven't seen that before. We haven't seen folks do that successfully in venture. Um, it was more a sense of, hey, this is interesting, but we're not yet ready to kind of invest.
Mm.
And I think whenever you get that response, it's a logical response because not investing in a venture firm that's raising a fund one, nobody can blame you for that. Like any new venture
Right.
fund is risky, and a lot of
Yeah.
folks get that response. But I think what we saw was maybe more of a reluctance from folks, especially institutional LPs.
Mm.
I had friends who had the same amount of experience or less experience raising from institutions really early on, and kind of making a strong case and raising much bigger funds than we did for Fund One. Um, and what I concluded was that folks really had to see it to believe it, right? So I believe that one of the reasons why, and this applies to both folks investing in venture funds or startups, one of the reasons why there may be implicit biases around investing in folks of color or women is that folks haven't seen so many examples of big success. And because you're in an outlier business where there's a power law that applies and applies to funds in the same way it applies to startups, um, folks are kind of saying, hey, like what does exceptional kind of off the charts performance look like? And one way to reduce the implicit risk of that is to invest in things that look similar to things they've seen be successful before, like in big ways.
Mm-hmm.
Um, and so if you're looking at a new firm started by two folks like Aaron and I, who are African American, who hadn't worked together before or co-invested together, who are both coming out of good funds, but Insight's a growth firm, not really perceived to be great in early stage. Aaron didn't have a lot of experience as an investor. Those multiple risks make people say, hey, like I need to see it to believe it,
Yeah.
right? Like I want to wait to fund two or fund three or what have you to kind of really see this thing de-risked. And I think that happens a lot to folks. And I think it's not something that's unique, so to speak, to folks of color, but I think those perceived risks are magnified.
Yeah.
Right? I
It's
think folks
it's
see
interesting.
them more.
Yeah, the investing thing's interesting because I talked to a lot of underrepresented founders on this
Yeah.
podcast, and a few have said, then they're underrepresented, and then they go and they invest also in underrepresented founders, and at some point you kind of think, well, maybe you're the amazing thing, like you in general, you're the amazing thing. You're the underrepresented founder who became a VC, you don't have to go solve everyone else's problems too. Like, let Mike
Yeah.
Moritz go do that. Maybe you
Yeah.
should just go invest in Travis Kalanick and make a ton of money. And don't
Yeah.
like, you don't have to solve everyone else's problems, I guess. So
Yeah, I think that's another topic that's interesting. I think, folks of color, the perception is, hey, you're going to invest in other folks of color, or that should be your mission, or in the same, I think, is applied to women. If you're a female, building a venture fund, the perception might be, hey, like you're only investing in female founders or primarily doing that. And that's always a little bit tricky because on the one hand, you want to do that, right? So we have several companies that are being built by amazing founders of color. I mean, Squire is a good example. AppDeco, we have a lot of them. Definitely a much higher percentage than most firms. But one of my beliefs is that as an investor, you want to have as broad a possible aperture to find the exceptional founder
yeah,
because it really is a power law business, right? Like it really is a business about investing in the very small percentage of companies that are going to be the massive winners. Like that, in my view, that's the entire game. And as a firm, you're trying to figure out like what's our proprietary way of doing that, right? And so one of the challenges sometimes is that folks may perceive you to be investing in a more narrow aperture or a more narrow set of founders. And there's nothing wrong with doing that. I think that can be a way to generate returns, but you're just kind of maybe fishing in a smaller pool.
yeah,
Um, and so it's always a little bit tricky there. It's always as a firm founded by two folks of color, when you're pitching LPs, is a little bit of a dance. Like,
yeah,
how do you explain what you're really investing in? Do they buy that? Do they come in with preconceived notions about what they think you should be investing in, or what have you?
yeah.
Like it's interesting. I think it's a
Yeah,
really
it
interesting
is. I had a great
question.
African American woman who's a great venture capitalist on, and she said she had an issue, and there's only a white guy can not you can't experience it, but you can listen to the story where she would get, she'd go to an investment group and they'd be like, oh, you should talk to our foundation, like the
Yeah,
giving side of it. She's like, no,
yeah,
I want your money to go make you more money. I don't want
yeah,
your
yeah,
that side of the
yeah. That's a
house.
great point. I think sometimes like investing in kind of folks of color is conflated with mission driven investing and kind of investing from a nonprofit perspective or not from a return driven lens. And I always wrestle with those things because on the one hand, you're like, look, folks that are doing mission driven investing or kind of folks that are trying to your point, invest in great causes or what have you, those should be celebrated and those are great. But like when you start to conflate aims, it's when things, in my view, sometimes go awry,
Yeah,
right? So if you're an LP investing in a diverse firm because you think it's a good thing, but it's not per se driven by returns, when the market turns down, when you're really kind of like figuring out like where do you want to reinvest in and you're applying that kind of return driven lens, what happens, right? Like you might say, hey, like I'm not investing in that firm or reinvesting in that firm because I don't view them through a return driven lens, right? I view them through a different lens. So I always believe that you want to have consistency and really kind of, especially when you're looking at investing in folks that historically have received less capital.
yeah,
My perspective is there shouldn't be a different lens. It should be the same lens, right?
right.
Like you should really think through like what are your assumptions around returns. I think where it breaks down oftentimes is that people have implicit biases around what's going to generate returns, and it's kind of those are camouflaged by a mission driven approach or a do good approach, or I'm doing something good for the world. And that can be fine when you're making a first investment, but I don't think that's a scalable approach.
Yeah, that's right.
I think there's a lot of issues with that.
So it goes well for you in the end. It
Yeah,
seems like you have a
it's
$350 million
Yeah,
fund. You're
yeah,
with your partner. You got through all that.
yeah.
It's an incredible achievement. What do you think is the biggest lesson you learned about? I think it's very different to work at a great firm like Insight
Yeah.
and build a thing. What do you think is the biggest lesson you learned about building a venture firm, the entrepreneurial part of what you've accomplished here?
Yeah, yeah, and thanks for the compliment. So I think the biggest thing that I've learned so far is that as a fund manager who's trying to build a firm that can compete with the big guys and really be successful over the long term, you need to do things that are contrarian. It's almost a prerequisite to be successful. And as a result of that, especially in the early years, you don't need the vast majority of folks to believe in what you're doing. You almost don't want that to be the case because it's consensus. What you want is a smaller number of folks, and these could be LPs or founders who choose to take your money. You want those folks to see what you do uniquely, and you want to be able to really articulate that in a very coherent way. So one of my beliefs is that the exceptional funds that get built are oftentimes doing something different, right? So it could be investing in a certain stage. So if you think about the growth of seed in the early days, like those firms were doing something fundamentally different than traditional venture, which was writing larger checks, companies that are further along. Seed funds had a very distinct, pitch, 15 years ago. And you can kind of see that across new firms that are very successful. So whether it's a stage focus, whether it's a geography focus, whether it's a certain type of technology, a certain type of founder, you really want to hone that differentiation. And I do believe that it's likely to be contrarian differentiation, because if it was non-contrarian, the big firms would be able to do it, right? So in my view, you want to figure out, like, what are the things that firms like Sequoia or Benchmark not doing? What are some things that might be perceived to be, hey, there's not a lot of returns in that, or the conventional wisdom might be like, that's not going to work. And then you really want to double down. You want to have a belief that that's going to work, some evidence that that can work. And then you really want to kind of like do the best you can in the early years to kind of put in place a structure and a process that's repeatable to enable you to kind of do that at larger scale.
Yeah.
Right. So those are some of the learnings. So Aaron and I kind of spent a lot of time thinking about, okay, like, what's our portfolio construction? What type of founder do we want to target? Kind of like, what's the sweet spot in terms of investment size? If we're applying like a multi-geography approach, like, what does that look like? What are some of the things that conventional wisdom might say, like, hey, either don't do that, or that's going to be really hard or more difficult or more challenging. Let's lean into those things, because if we can kind of make them work at a small scale, we can kind of really build it and get larger. So that was the biggest learning. And I think it also, for me and for Aaron and I, kind of gave us confidence that, hey, like, we don't need the majority LPs to kind of buy our approach. We only need a small number of people to really buy into this. And this isn't going to be something that is going to be super popular in the early days. Like, it's only going to be when the returns start to manifest themselves, maybe more folks kind of buy into it. So that's maybe the biggest learning overall. Does that make sense?
Yeah. Was there a fundraise for, and you took from Insight, what did you take from Insight, the firm and brought that you think makes sense in what you're doing now? Was any of the data piece or the outbound piece?
Yeah. So in my view, there were three elements that really kind of defined or kind of drove Insight's success. The first was a very tight focus on software companies, which may seem conventional now, but when they were first building the firm 20 plus years ago, only investing in software, primarily B2B software, was actually a little bit contrarian. So the first thing was this tight focus on software companies. Why? Because, great unit economics, you can build them with a small amount of capital. You can distribute software now kind of across the world relatively easily. So I saw the power of investing in software companies. We kind of focused in on specific themes within software. So we have 4 themes that we kind of prioritize. But the first thing was this focus on software companies, which is a commonality between our firm and Insight. The second element was the power of outbound sourcing. So I kind of seen that model work at the growth stage. I believe strongly that it could work really well at the early stage, but you had to kind of tweak what you were looking for, and you had to kind of like really evolve the model to be less based upon, traction and revenue growth, and more focused on founder characteristics, market characteristics, early product characteristics. So you could kind of build an outbound sourcing model, but you'd have to apply a different lens and different approaches to that. And then the last thing was the power of a value add program. So Insight although it's not really celebrated, was one of the first firms to really build an agency model. Firms like Andreessen and others really kind of publicized that, but Insight was building this amazing team they call Onsite in the early days. And this was a team of like really talented specialists that could kind of come in and help you build a sales team. And if you were doing telesales, they could help you build that, or if it was direct sales or, online marketing, and, they could do all kinds of things around recruiting and helping to find acquisitions. And so I kind of saw this power of the platform, not only to help you win deals, but also help these companies get bigger and really grow and scale. And so that last piece also, Aaron and I really prioritized. We call it our success team. We thought a lot about like, what are the biggest challenges that software founders kind of experience in the first, year, 2 years of their growing their companies, and how could we really help those companies to grow? And so we really kind of have built this success team to kind of help founders in multiple different ways. So those were the three elements that I would say we took from the Insight approach and really honed. And Insight's one of our LPs, so they've been very supportive of the firm. We've done a few deals that they've kind of followed on and led. So we've got a great relationship with them.
Yeah, that's great.
But yeah, there was definitely some learnings from Insight.
And so as you sit, at this perch such that it is a successful fourth fund, kind of on the board of the NVCA, I'm saying that right? What do you, kind of, I'll get your kind of, maybe final thoughts here on just kind of the broad market, interesting times in venture. Start with the, the negatives as, we've had this big come down in valuations of firms. We had, it almost feels like a dream now, but we had the Silicon Valley Bank and First Republic, which are kind of key banks for venture capital firms, fail, and sort of got this interesting sense. Maybe I just felt it here in Silicon Valley of people almost cheering for that, like a little bit of Schadenfreude about venture capital firms, although nobody ended up getting hurt on the venture side. Really, what do you make of what's going on in our world here?
Yeah, so I started my career in 2002, as I mentioned, which was kind of post the dot-com crash. So I was able to kind of see the industry in my first couple of years, kind of coming out of a time similar to this time, right? And I would say that time was even a lot worse. Many funds were going out of business. You had some pretty dramatic bankruptcies. I think because at the time, like, companies just generally had less fundamentals and less substance. Many of those companies, there was even more of this drastic, kind of like nuclear winter, as one of my colleagues described it at the time. And so I think that was a great time to begin my career, because it really was all about, hey, in this tougher environment, which founders are resilient to kind of want to build a company and kind of stick with it. When it's not popular to start a company, who wants to go out and kind of do that? When it's harder to raise, if you're a founder, and also as a VC firm, kind of like harder to raise a fund. I remember Insight, had trouble raising, I think, Fund 4 and Fund 5, even though their performance in the early years was great.
And I will say, like, that period compared to now, it was completely different. I mean, funds were shutting down, returning money. They were people would say things like, everything that's ever been invented, that ever will be invented on the internet, has been invented. So next time you hear that it's all over, 2002, exactly. And people were scrubbing like internet, the way everyone's Web3 is disappearing from everyone's website now. Internet and software was just disappearing from websites. All over the place.
I remember, you might remember a website, fcompany.com. I don't know if you remember that one, where basically every day it was basically a description of like the company that went out of business that day, or the multiple companies.
By the way, the writer of that has now gone on. The guy who wrote that, Phil Kaplan, has now gone on to build like $1 billion company.
Is that right?
Called DistroKid. Yeah, I think it's not even venture funded. It's like a music distro. Anyway, he did okay. So.
That's hilarious. Yeah. So long story short, having started at that time, I think gives me a vantage point. And I see a lot of similarities. So I believe that this is a great time to be investing and a great time to actually be starting a company. Why? Because I feel that there's less of the tourist investors, less founders who are doing it because they think it's cool, or folks wanting to get into tech because it's the sexy thing, and a much higher percentage of folks that are kind of in it for the right reasons. right? Either they want to invest in great companies for over the long term, or they want to start a great business and they're really kind of focused and persistent in doing that. And also, just from a pure economics perspective, when you have less of a supply of capital, and I think what you're going to see over the next couple of years is, and you saw it last year in terms of a drop in terms of how much money was raised by VC firms. And I think you're definitely going to see a continued drop over the next couple of years in terms of VC funds raised. Now, there is a pretty big capital overhang, right? So a lot of firms raised massive funds back in 2020 and 2021. So it'll take a while for that capital kind of to shake out or to kind of shake up through the system. I think given that you have some structural characteristics that I think will enable this, current vintage to be really good. So a combination of new technologies that I think will drive amazing innovation, AI being the obvious one.
Yep.
I think that's a massive game changer, but I think there are others. I think it's going to be really fascinating to see what comes out of the Web3 and crypto world. There's obviously been a big crash there, but I think coming out of that, there's going to be some founders that are resilient, building interesting companies that have real fundamentals and revenue and kind of great characteristics. And so I think you have like multiple technology areas that are likely to kind of drive great new innovation, combined with firms that really, again, are in it for the right reasons, right? Are kind of trying to invest in companies that are fundamentally sound, not trying to invest because it's a popularity contest or it's the next cool thing. So I think it's a great time to be investing. We tell our team, like, we think this is an awesome time for us to really, capitalize as a firm, right? Like, we believe that next couple of years, if we play our cards right, could be a great time to invest in some amazing companies, and really back amazing founders and support our existing founders, and also really kind of build our firm and build our brand. So I find it to be really exciting, honestly.
Yeah. And it's pretty supported by the back test, I think, if you look at when the great companies were found.
Yeah.
And this is like the Warren Buffett thing, too. Everybody knows the trick. Like, everybody knows that you're supposed to invest when it looks worse.
Yeah.
That's not the problem. The trick is the doing of it.
Yeah.
So.
I think that's right. And I think venture is really the ultimate in, you might say, kind of like the herd mentality. The draw of the herd mentality, I think, is biggest in venture as opposed to other asset classes. Why? Because, one, there's a lot of uncertainty, huge risk. It's hard to really understand pure fundamentals in the early days. Right. You have this power law concept where a small number of companies generate the vast majority of returns. I think all those structural factors drive these kind of herd mentality approaches where people kind of, like, in their mind, de-risk their investments by investing in something that somebody else did, or somebody else that I think is great and is investing. And so I think, to your point, like, the draw is biggest to kind of be consensus. And I think the real challenge as a VC is to kind of, like, block some of those things out, right? And kind of really think about companies based upon first principles and try to be an independent thinker and also kind of go against the grain. And so I think these are periods where that type of behavior is really rewarded. But yeah, to your point, it's much easier said than done.
Basically do the opposite of VC Twitter. so let me, I'll finish up on this. Oh, before 645, what's the meaning of it?
Yeah. So 645 is actually a local phone code in Massachusetts. I mentioned I grew up. I don't think I mentioned that, actually. I grew up in Massachusetts. So it's a local phone code where I grew up. Kind of represents family, community, etc. So when we first started the firm, it was actually a placeholder before we had something that was maybe better. And Aaron said, that's kind of cool. It's number, it shows up really high. You're like, so kept it, but that's kind of.
You're like the Foo Fighters. That was just a placeholder name that Dave Grohl said he would have never used if he knew the band was going to become successful. And you're in New York.
Yes.
You're a Boston sports fan?
I am.
How is this? And you're on the so this blew my mind more than anything. You're involved with Jazz at Lincoln Center in New York. You're in New York, and you know what people think of Boston sports fans. How does this possibly work? Being a New Yorker.
Yeah, that's always been a tough thing, right? Because I am a big sports fan, and I wear my Celtics gear or what have you. Kind of like, that can be a challenge walking around New York. But kind of, I guess it's just part of the, it comes with the territory. Like, I do every now and again go to sports events, in New York City. So I watched the Knicks a couple times in playoffs this year. And we opened up a West Coast office 2 years ago. So I'm spending a lot of time in SF now. So I go to see the Warriors every now and again. But I'm definitely a diehard Celtics fan, Patriots fan, Red Sox fan.
It's crazy. Look, this has been fantastic. How do people find you, follow you, understand what your is it Twitter? Should they go to
Yeah.
your
Yeah.
website? Like, what's the best way for people to keep up with you?
Definitely. So, our website, 645ventures.com, folks can see, our portfolio, kind of where we focus. Yeah, definitely, kind of hit me up on Twitter. The Data VC is my Twitter name. But yeah, we kind of definitely accept kind of folks sending, deals to us. Excited to kind of hear, and see new great things. So folks can definitely hit me up or our team, and we're excited to kind of look at your company.
Cool. Well, thanks so much for doing this.
Thank you. This was great.
All
Thanks,
right.
Dan.
Well, this has been the Something Venture podcast. My guest, Nnamdi Okike. Talk to you next time.